Welcome back to the Manor, Entropians. Julian McBain here, and today I am going to continue on with my Personal Finance for Gamers series once I start fighting drones here, which of course is just ancillary to what the conversation is going to be about. We're going to talk about investments and the different types of investments, and because of that there are a few things I need to say. First off, I am not currently a registered investment or financial advisor. I am not providing investment advice. I have been registered in the past. I am currently not in a role that requires it, and therefore I'm not registered. If you like anything you hear here, speak to a registered investment advisor or financial advisor to find out if any specific investment is right for you. Only you and they can make that decision. This is strictly for educational purposes. Okay, that'll keep FINRA happy. So, investments are basically, they're generally used as an advanced form of saving, but they're saving with risk. So a savings account is FDIC insured up to a certain point. It generally has a very low interest rate or an annual percentage yield, but you're not going to lose the principal unless the bank goes belly up, and even then Uncle Sam insures it up to a certain point. Generally $250,000 per account labeled in a particular way. Investments are different. Investments rely on the market to make you money. Therefore, they carry risk, but have a better chance at higher return. Or I should say they have the chance of a higher return. Because you're never going to see a savings account with a 5% interest rate. It's just not going to happen. At least not, it hasn't happened in my lifetime. You know, it was huge when it was back when it was 2%. So, we're going to go down the list of investments that I'm familiar with, at least from an academic standpoint. I have some experience with some of these. I have less experience or no experience with others. Some are things that you need to go to a financial advisor for, others are not. So keep these things in mind as you're listening to what I am saying. And if one of these categories interests you, find a financial advisor in your area, your state or country, and find out if that particular type of investment vehicle is right for you. Okay. The first one we need to talk about is equities. These are stocks. Pretty basic. You buy a share or shares in a company, and you stake your money on the idea that that company is going to gain value. And then as it gains value, they'll also pay out dividends, which is your share of the profits. Most people are invested in the market in shares in some way, shape, or form. Oftentimes they're not individual shares, they're in mutual funds, which we will get to in a little bit. But your 401k, there's going to be underlying companies there. And I'm not going to get too deep into that quite yet. I'll do that more when we get into mutual funds. But when you buy a share of a company, you're investing and taking the risk of that company on up to the amount that you invested. And in exchange, if the value of the company goes up, the value of your investment goes up. And if the company profits, they're going to kick you a piece of that. Generally, these shares are purchased in 100-share blocks. So if you go to buy Disney, you're going to buy 100 shares of Disney, not just one. Buying less than a block of shares generally incurs higher commissions or fees because it is more expensive for a firm to parse out shares like that. Just be aware of that. The benefit to equities is you get to select the companies that you're investing in individually. And you can take whatever criteria that you personally have for investing in something as your methodology, whether it's from a moral standpoint or because they're doing very well or because you think they're going to do very well. It's whatever your personal criteria are. The downside is that it carries both what we call systemic and non-systemic risk. So systemic risk is something that's very hard to prevent. This is market upswings and downswings. You know, across the board, the market will always go up and down. For instance, right now, we're in a pretty sharp downturn. It's due to things that are happening in the world right now. There's not much the market can really do about that, so it just reflects the confidence of consumers. That's a risk you really can't prevent from being in the system, hence the term systemic risk. Non-systemic risk is the risk carried by investing in an individual company. The leadership of that company could do something very, very stupid. Take out too much debt, violate employee rights. They could violate labor laws. They could ignore safety rules. That's all non-systemic risk. And so that stock could tank because someone did something dumb. So those are the two risks involved with doing individual equities. That being said, it allows you to really dig down and decide who you want to put your money on. So that major benefit, if you're willing to accept the risk, is included there. Now keep in mind again, generally when purchasing stocks, you do so in 100-share blocks, and that can make purchasing individual stocks more difficult. Now that again comes against some more modern investing houses that have come up recently where it's all self-directed investing, and you run into things like Stash where they do fractional shares. So that's much less prevalent now than it was, say, 10 years ago. But again, these are all things you're going to want to discuss with a registered financial advisor. The next one we need to talk about are bonds. Now, a bond is different from a stock, but it's still an investment in an individual company. The difference is that a bond is a debt instrument. You are lending a company money, generally $1,000 face value. And in return, every year they have to pay you interest, which is at a fixed percentage rate. I think the most often one I see is 5%, but they can range. And it all depends on the current prime rate is what they're going to issue bonds on. So when you go to purchase bonds, be cognizant of that. Now, bonds also fluctuate with the market, but they fluctuate differently because it's based more on the interest rate and less on demand. So if you are holding a 5% bond, but the current market interest rate is 6%, that 5% bond is going to be cheaper to make it so that the total that you put into it to purchase it off of whoever you're buying it off of, that return ends up being 6%. It's kind of complicated how that works, and I won't pretend to understand all of the nitty-gritties of it, but I know that as interest rates go up, bond prices come down. As interest rates come down, bond prices go up, because if you have a 5% bond but the prime rate is 3%, then obviously that bond is far more valuable. Now, an interesting thing about bonds is that they tend to be fairly stable. As long as the company doesn't go belly up, that bond will always pay out, because they're obligated to pay bondholders like any other debtor before they pay their shareholders. So you have a certain priority over equities. The other thing is no matter what you purchase the bond for, as long as you hold it to maturity, bonds are generally, I believe they're generally 30 years. It might be 10 years. Bond terms can vary based upon the company, but let's say you pick up a 10-year bond, the 5% interest rate, you pay face value for it $1,000, you collect your 5% every year. It doesn't matter how much the market value of that bond is when the bond is up at the end of 10 years. If you still hold that bond, you turn it into the company that you lend it to, and they have to pay you $1,000, even if the market went completely wacky and the bond's only worth $300 market value now. So there is that. And again, this is something that you'd want to discuss with an investment advisor, get more details on any specific investment. That's the gist of how it works. Note that there are always exceptions. So before taking an individual gamble, talk to an investment advisor. Please. Okay. Next form of investment are mutual funds. And this is something I was actually specifically licensed in. Mutual funds are investment companies. So basically, the way you form a mutual fund is you start a company, you buy shares in other companies, and then you sell shares of your companies to your company to investors. So basically, the holder of a mutual fund share is invested evenly across all investments that investment company holds. The benefit to a mutual fund is if you are in a position where conflict of interest is a problem, mutual funds help to mitigate that conflict of interest because you don't know what that company's invested in. That's actually part of why they do it that way. This is something that politicians can do without fear of there being major backlash in the event an individual company goes belly up because they had no clue they were invested in it. There was a mutual fund who they were invested in, so it doesn't matter if that mutual fund is invested in something that the individual investor would otherwise have a conflict of interest in, because the fund manager doesn't really know the names of the people who invest in it. That's all kept separate. That's keeps it so that conflicts of interest don't happen. And yeah, I'm sure there's some method they could break that veil, but you're talking about you'd have to go through way more steps than necessary than to just, outright buy the stock and hope no one catches you. Okay? Mutual funds are actually best for small-time investors. And what the definition of a small-time investor is depends on the advisor. But basically, I've always used the guide of if the person is not an accredited investor, default to mutual funds. If you don't know what an accredited investor is, ya ain't one. Why did I do that? It's that simple. So, mutual funds, again, you are invested in all things that the company invested in equally, and so that way you carry less risk. Because let's face it, if let's say you invest in a mutual fund and that mutual fund holds 20 different companies or stocks. If one of those companies goes belly up, well, it's not going to matter because it's going to be a much smaller proportion of your investment in that mutual fund. The mutual fund may go down, but it's not going to lose all of its value. And the investment advisor or the investment manager inside can always drop that stock and pick up a new one. Now, oftentimes, mutual funds will have stated goals. They might be trying to match the market, or which is known as an index, or they might be trying to all focus on a single industry like tech or banking. These are all things you can consider when selecting what funds you go to. And again, review these things with your investment advisor. But if you're looking to mitigate systemic or non-systemic risk, a mutual fund is the way to go, because it doesn't matter if one company in the fund goes belly up, the other 19 will support the fund. This is also what all of your 401ks are basically invested in. I have never seen a 401k that is not primarily mutual funds. This does not include employee stock purchase options, where you can buy your own company's stock in a 401k. But all of your 401k options, like any target funds that you see in there, or index funds, those are all mutual funds. So, in all likelihood, if you have a retirement, IRAs work the same way, by the way. Unless it's a bank IRA where it's all CDs and you're actually losing to inflation, all of your brokerage IRAs are generally mutual funds, because it is much easier to be a fiduciary, because when you're a fiduciary, which is what Series 65 investment advisors are, it's much easier to mitigate the risk as a fiduciary to your clients if you're using mutual funds, because they don't carry that non-systemic risk. Okay, those are the things you generally trade on the market, and those are things that absolutely require a financial advisor to get right. I mean, obviously you can go to one of the individual apps or self-directed trading opportunities. There, every bank or every broker dealer has one. Most banks have an associated broker dealer, but there are other things you can also invest in. Some require investment advisors, some do not. All of them, you should speak to an investment advisor. Because just because the investment advisor isn't the one who brokers these items doesn't mean they don't know about them and don't know the various advantages and disadvantages to them. So, first of these that a lot of people think about is real estate. Real estate carries with it a lot of different advantages and disadvantages. First off, real estate is very rarely worth nothing. In fact, I've never heard of real estate being worth zero. So even during the 2008 crash, when all of the real estate lost a huge amount of its value, it still wasn't worth zero. And that's because land will always be at a premium. Space is always an issue. So the benefit to real estate is that it's physical. You can retain personal control over it. You can actually go there and stand on it. And it's not made of paper. It's not made of blue sky, hopes and dreams. That being said, the land has to be useful for something. You could own 100 acres of swamp, and that land is never going to be worth very much because you can't build houses on swamp and you can't farm it. Now, if it's good hunting, like if you live in the Everglades and you own good hunting ground, that's a different story. That could bring value to it. Monetizing it could be difficult, but it doesn't mean impossible. Generally, if you're buying land for investment, there are two things you're looking for: either to collect rents or to flip it at a higher price, either before or after improvement. The advantages to doing so to collect rents is that it's a steady stream of income. It's monthly, especially if you are self-managing, or if that's how your rental company that you hire does it, or if you form a rental company to manage it for you. It pays monthly as opposed to quarterly, generally speaking. As long as you can keep tenants in there, it'll continue paying. And you retain a large amount of the control over the investment. You can't control a company when you invest in their stocks unless you buy a ridiculous amount of their stock. On the other hand, if you buy an apartment building, you can control how that apartment building is operated. Downsides. Maintenance is a problem for all rental units. And I don't mean that as in a huge problem necessarily, but furnaces break, roofs need replacing, windows sometimes need replacing, you can get bad tenants. There's all kinds of factors and moving parts with owning rental property. I know this firsthand. My old man used to own rental property, and there's a reason I currently don't own rental property. No. Because believe it or not, financing rental property, even when you are low on cash, depending on the bank and depending on your history, isn't necessarily overly difficult. But you have all these moving parts, and oftentimes it is not worth the headache. It can be worth the headache, and there are people who make fortunes on owning real property. There are also those who lose their ass on real property. Alternative to owning real estate for tenants, like apartment buildings or fourplexes, duplexes, something like that, is farmland. This is very popular in the Midwest, where you'll have landowners who've inherited their section or even 80 acres, and they don't have use for it because they don't want to farm the cows themselves, so they rent the land out to a local farmer who does have cattle for $2,000, $4,000 a year. It's not a huge amount of rent, but it's a supplement to your income. And depending on the number of acres you have, that could bring a pretty substantial income in. That's stable. It's annual, so it's not as often as, say, having tenants in an apartment building. But it also carries a lot less risk because, let's face it, you don't have to worry about maintaining grass or seed land. That's what the renting farmer does. That's why the rent is really low, because they're taking on the risk of having to maintain it. If there is a hailstorm, that is something that you might have to take on part of that risk for, depending on your contract with that farmer. So these are all things to consider. Again, discuss it with an investment advisor. Also consider discussing it with real estate professionals. to carry off or to tangent off of real estate, you have an alternative to just holding real estate, which is a real estate investment trust, or also known as a REIT. So a REIT is where a company is formed, much like a mutual fund, except instead of being invested in other companies, they are invested in properties. So what'll happen is, let's say you wanted to form a REIT. You buy 10 properties, apartment buildings, let's say. You drop them into the REIT and you sell shares of the REIT. So now your investors are giving you money, which allows you to pay down mortgages, maintain the property, what have you, immediately. So there's more equity in those properties. And then you have to divide up the rents to your investors, and you take a small percentage. Usually it's like 1%. And that's your management fee. So you don't get to get all of the money from the different real properties, but you also carry like none of the risk, or a very minimal amount of the risk. So that's if you're the investment manager. If you're investing in a REIT, then you're putting the money in. You don't have to deal with all the moving parts of managing those properties. You just put the money in and you take your cut. Now again, investing in real estate investment trust still carries a lot of the risks that come with owning real property. The difference is that's not your headache. You just have to worry about whether or not the share goes up or down. If you get your rent, your dividends at the end of every month or quarter. And so basically what it does is it means that you can basically say you've got all the advantages of real estate with none of the headaches. But then it's also not directly under your control. See, the benefit of control, the benefit of the headaches is you have the control. You give up the headaches, you also give up the control. Every REIT is different. More so almost than companies. Because companies can be blocked out into things like your large cap stocks, which are also known as blue chip stocks. They're generally safer. These are your big companies like your Walmarts and your Disneys and your Targets. You have small cap stocks, which are riskier because they're smaller businesses. They might be newer. REITs, each individual REIT is going to have different aspects that you need to pay attention to. They might be invested in farmland. They might be invested in single family homes. They might be invested in big apartment buildings. And all of those carry different advantages and disadvantages. So you need to do your research on REITs. Or hire someone to do it for you. That's the purpose of an investment advisor. Okay, kids. Last thing on my list for this particular lecture is commodities. Commodities are generally purchased as a hedge, but not always. There are people who make a lot of money in commodities. What are commodities? The most well-known commodities, of course, are gold, silver, and other precious metals. Gold and silver are expensive due to their rarity. Gold much more than silver. Like an ounce of gold right now is $1,600 versus an ounce of silver, which goes for about $14. This is as of yesterday. I think gold was at $16.80 and silver was at 14 something. The benefit to precious metals is, generally speaking, they are a hedge against inflation. There was a time when we were on a standard where the dollar was pegged to gold, and so that's how you valued money. We are not like that anymore. The dollar now fluctuates, but it's assumed, and this is not explicitly said, but it is increasingly implied. Gold does not fluctuate against the dollar. Dollar fluctuates against gold. It has always kind of been the standard, even though it's not on a standard anymore. It's used as a mark for comparison. Does that mean gold is the right investment for you? Not necessarily. But commodities are often used to hedge against risk, hedge against downturn, hedge against especially inflation because of the way they work. There are other commodities besides precious metals that you can invest in as well. Things like oil is a commodity. So determining what, specifically crude oil. So determining what commodities might work best for you is another conversation you need to have. Now keep in mind, most investment advisors are not licensed to broker commodities. They would have to farm that out or tell you where to go. They may tell you that it's not necessarily a good thing to have in your portfolio. And that is a decision you're going to have to make. No matter what, an investment advisor is there to help you. They are there to give you advice, but that's all they're there to do is give you advice. Now, you can hire them to manage your portfolio for you, and they'll take their 1% and you'll get the rest. And that's a mutually beneficial relationship because the advisor wins when you win and the advisor loses when you lose. But in the end, if you tell an advisor to purchase something that they are able to purchase for you, because keep in mind, these things are all heavily regulated, and people do not necessarily have the ability to purchase what you're asking them to purchase. You know, you can't ask someone who's not licensed or registered in commodities brokering to buy you commodities. That is illegal. Or you can ask them if they have to say, I'm sorry, I'm not licensed in it. You can't say, well, you have to do it anyway. That would be illegal. On the other hand, they can say, well, I can't do it, but this other person I know of does. So you're going to have to go see them. That's a thing. So, for instance, when I was registered to sell mutual funds, but I was not registered to sell stocks. Plain and simple. I'm currently not registered to sell anything, which is why I'm only providing academic information as opposed to being like the Motley Fool who goes out there and gives specific advice. So, that is my lecture on investments. There are far more complex things that go into the investment world. I haven't even touched on things like options. If that is something people are interested in, please leave a comment down below, and I will dig out my Series 6 study guide, which is sitting, actually, I won't even have to dig it out. It's like within arm's reach of me because it's always within arm's reach of me. And I will be more than happy to go through what options are in the investment world. Again, it will never be considered advice. It is simply information. Always defer to the advice of an investment advisor, and keep in mind that these things change over time, and it has been several years since I've worked in the industry, and so my advice, my information may be dated. So get up to date. Now, that being said, most of this doesn't change very much over the course of time, but take advice from people who are currently doing it. And I'm going to end on this note. As someone who holds deeds and shares in Entropia Universe, this is not an investment. I mean, it is, but not from the point of view of investing. It's risk. Sometimes that risk pays off. Over the last 16 years, it's paid off really well, but it's not a security. At least not from the strict definition of the term, so just keep that in mind. So, that's all I've got. Thank you for watching. Thank you for listening. Please like, share, and subscribe down below. We are on the road to 13 million subscribers, one subscription at a time, so make sure you subscribe. Guys, I really hope that this provided you with some good information to allow you to educate yourself about your finances. I'm going to continue doing this series a little while longer. I have some more things to touch on. I am looking at seeing what else I can do to try to provide information to gamers, because I do think that gamers are possibly one of the most underserved communities. We have a lot that we can do. We don't use nearly the potential we have, and so I think that by providing this information, I am helping you have the opportunity to bring yourself to your full potential. So again, thank you so much for joining me today. You all have a wonderful day.